morning, ladies and gentlemen. This morning, I want to talk about what I think is the best part of being an angel investor. It's when we get to sell one of our investments. I want to start off with a couple of qualifiers on this presentation. I was a technology entrepreneur, and now I'm a technology investor. And my comments come from that perspective. And I want to acknowledge up front that there are some differences in clean tech and life sciences. I also want to say that I'm not going to be talking about public market exits, at least not until those come back again. Organized angel investing is still quite new. The earliest groups got started around 1997. And I think angel investing today is about where venture capital was in the early 1980s. We're still discovering what works, and we're still discovering best practices. The financial world has also been changing quite a bit recently. And that's why I think this type of gathering, this type of meeting, this type of information sharing is so valuable. To put my comments in perspective, I'm a geek. I got a PhD in electrical engineering from the University of British Columbia. I started my first company when I was in grad school. Nexus grew quite rapidly and became the second largest manufacturer in the world of cable television head-end equipment. And we sold that in 1993 to Scientific Atlanta, and now that's part of Cisco. When I sold Nexus, it was the first time that I actually had money that I could invest. And I've been an enthusiastic technology investor ever since. I started a hedge fund, a venture capital seed fund, and most recently, an angel fund. I learned, and I admit quite expensively, that successful investing requires two things. First, to buy right, to make the right investment decisions and to use the right structures. But I learned late that it's also very important to exit well, to get my money back at a good value and in a reasonable time frame. And this morning, I want to talk about that second part of the process. I'm going to be talking about M&A exits. I became fascinated with early exits in 2002 when I started a venture capital seed fund. It really worked more like an angel fund, but it was, strictly speaking, a venture capital fund. The BC government is one of the leaders in Canada in providing tax credits to stimulate angel investment. And they provide a 30% refundable tax credit to investors in qualifying venture capital funds. But under the legislation we have in BC, the investors can ask for their money back in just 5 years. And that's less than half the time that traditional venture capital funds have to produce a return and get some liquidity. And I knew that if I was going to be able to provide liquidity in only 5 years, I was going to have to start by focusing very intently on the exits. I managed the BC Tech Fund for 3 years, and during that period, I made 9 investments, and in that 3 years, had 3 exits, 2 acquisitions, and an IPO. That experience taught me a number of things. One is I believe that early exits can be designed into the corporate DNA and into the term sheet. I think early exits increase investment returns, and they work well for entrepreneurs and angel investors, but maybe not for traditional institutionally backed venture capital funds. I also think early exits are a lot of fun. I think we can all increase our successful exits by focusing on the exit before we make the investment, and specifically helping the entrepreneurs to build an exit strategy that fits their company. Again, ideally before we invest. And designing our term sheets to facilitate the exit transaction, especially the vesting terms. And to really understand what happens when traditional, large, institutionally backed venture capital funds follow on in one of the companies that we've backed. The quick answer as to what happens when venture capital funds follow angel investors, and what got me excited about writing the book, is that it seems that angels and entrepreneurs have two exit alternatives. In companies that are entirely backed by angel investors, what we're seeing is a pretty good probability of an exit in 3 to 5 years. But when VC funds follow on, what we're seeing is that extends the exit horizon by about a decade. So it seems that our strategic alternatives are to finance entirely with angels, look for an exit in 3 to 5 years, or for the companies that need venture capital, we're looking at a much longer exit horizon with a considerably lower probability of success. I've also been working with a number of other angels on building a simple checklist to determine for a given company whether it's a candidate for an angel-only financing strategy or whether it does need venture capital. The most important criteria is how much money the company is going to need. And what's fascinating about angel investing today is that with the encouragement of the Kauffman Foundation, especially in the States, angels are starting to syndicate. I'm a member of the Bellingham Angel Executive, and Bellingham's a pretty small city. And I think because of its small size, the Bellingham Angels are one of the leaders in America in helping to build best practices around angel syndication. And they've actually signed formal agreements with, I think it's 18 other angel groups in the Pacific Northwest to share due diligence, to collaborate, to co-invest. And it's starting to work. I'm regularly seeing companies now that have had $5 or $10 million of angel capital invested in them. Not in one round, over a number of rounds. And I've invested in a couple myself that have had more than $5 or $6 million of angel investment. So that's the most important first determinant. If you need more than $5 or $10 million, it's probably not something you can do with angels today. Then you're looking at a company that does need traditional venture capital. The exit time horizon is also an important determinant. If there's a company that you're looking at that you think could be built to a successful exit in 2 to 5 years, then it is a good candidate for an angel-only financing. If you're looking at something which by its nature is going to take 10 or 15 years, then you're probably going to need venture capital just to fund the burn rate through that longer development cycle. The value of the exit is also an important determinant, which ideally you'd like to be able to make up front, which would give you some guidance on whether the company was better off with angels only or if it was going to require venture capital. If you're looking at a company that's going to sell for less than about $50 million, it's a perfect angel-only investment. But if you're looking at one of these high-risk, high-return kind of binary success factors where if it works at all, it's going to be $100 or $200 million, that's the kind of thing that makes sense for traditional institutionally backed venture funds. There are also differences around the control provisions and other parts of the investment agreement, but I'm not going to try and do justice to those today. I'm convinced that companies can be pre-selected for exit suitability depending on what your criteria are. And these days when I talk to angels, especially after all of the changes in the last couple of years, what I'm hearing is that angels would like to get their money back in 3 or 4 or 5 years. And I think it makes, thanks Frank, I think it makes a lot of sense for us to take a hard look at the companies that are being presented to us and ask ourselves if this is something that we can sell in 3 or 4 or 5 years. And to me, it's surprising how often entrepreneurs, because they just don't have the experience, bring us companies that either are really lifestyle companies or another category of even worse kind of companies that don't have any exit prospects or any reasonable exit prospects and ask us to invest.